Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Recently, I was doing a one-on-one coaching and I was having a discussion about loan denials. As some of you may or may not know, I have worked for a few banks in the past and I also have some experience with underwriting. This individual I was speaking with got denied for a SoFi loan, and it was only for a few simple reasons that were easy to prevent. So what if I told you that most people get denied for loans not because they can't afford them, but because they don't understand the criteria lenders are actually using behind the scenes? Banks, credit unions, and online lenders all use strict underwriting criteria, and if you don't know how to prepare before you apply, your loan application could be dead on arrival. Today, I'm going to walk you through a proven credit application strategy that lenders will never tell you up front, whether it's a personal loan, auto loan, business loan, or even a mortgage. This same information applies for the most part. Stick around until the end, because once you understand this, you'll never apply for a loan the same way again. And while you're here, please make sure to subscribe to the channel. I put out videos like this to help you master your money, credit, and funding. So without further ado, let's get right into the video. Let's start with the truth of why loans get denied in the first place. An underwriter can deny your loan for several reasons, and most of them have nothing to do with whether you deserve the money. The underwriter's job is to protect the lender from risk. They look at very specific data points. If you've ever applied for a loan and received a denial letter, then you know what I mean. By law, if your loan is denied, lenders must send you a disclosure letter that explains why. And here are the top reasons. Reason number one, a low credit score. If you're currently dealing with this right now, I highly recommend you check out my credit repair playlist in the description. I have many videos on credit repair and credit building that should help you on that front. Reason number two, a change in employment or unstable job history. Lenders prefer consistent and verifiable income to ensure repayment capabilities. And reason number three, a high debt to income ratio, meaning you already owe too much compared to what you earn. And I know this very well. You could even have an 800 credit score and still be denied if your debt to income ratio does not look very good. The painful part is that most people don't realize they could have fixed these issues before applying, and that's where this credit strategy comes in. Now, this is the one thing you must do before applying. You need to pre-underwrite yourself before they underwrite you. So what do I mean by that? Before you ever hit submit on an application, you should run your own financial profile through the exact same lens an underwriter will use. You want to spot the red flags before they do. This way, instead of applying blind and hoping for the best, you're walking into the process with a file that already meets their standards. Think of it like this. Would you ever take a final exam without looking at the study guide? Probably not. Yet people apply for loans every single day without understanding the lender's study guide for approval. So let's break down how to do this step by step. The first thing an underwriter will look at is your credit score. Not just any score, they will look at the FICO model. That is still the king of lending. Now, there are at least 16 different versions of your FICO credit score with various models tailored for different credit products like auto loans, credit cards, and mortgages. While some are more widely used, like the FICO score 8, lenders can also utilize industry-specific scores such as your FICO Auto Score 10 or FICO Bank Card Score 10 or even 9. I have an entire video that goes over these different models. If you want more details, I suggest you watch that video after this one. I'm going to link it right here. Now, speaking in a general sense, scores above 670 are generally considered good, 740 and above are very good, and 800 plus would be excellent. Now, here's the catch. Having a high credit score does not guarantee you approval or the best approval rates, but it definitely keeps you from being denied outright. Like I said, currently I have an 800 credit score, and because my debt to income ratio is high, I still get denied for a lot of products. Trust me when I say it does not help you just by having an 800 credit score. The most important part is having a structured credit profile, and I have another video that will discuss this in much greater detail. I'm going to link that video here as well for you to look at later. But this is why you need to look at more than just the score. Pull all three of your credit reports, Experian, Equifax, and TransUnion. I suggest getting your reports from www.annualcreditreport.com, and at the time of recording this video, you can get these reports completely free once a week. Go line by line and look for late payments that are still reporting, collections, charge-offs, high credit card utilization, errors on accounts that don't belong to you, and if you find any errors, you need to dispute them before applying. And if your utilization is high, a lot of people overlook this, pay it down. Every single one of these factors can make or break your approval. Once again, I have an entire credit repair playlist. Check that out if you need to. Now, if you're having issues with late payments in particular, I suggest that you join My Success University. It's a Discord server group that talks a lot about the things that we discuss on this channel in regards to financial literacy, as well as a whole lot more. Our moderator in the group does make custom dispute templates. I have seen some great results from a few members. I like to wait for more feedback before I put that in a video, but again, I have seen some good results so far. The link to join will be in the description. Step number 2 is to understand debt to income ratio. Your debt to income ratio tells them if you can actually afford new debt. This one factor is the most overlooked. Here's how it works. Add up all of your monthly debt payments. That includes your car loans, student loans, credit card minimums, and any other loans that you have. Then divide that by the total gross monthly income that you make before taxes. So for example, if your debts are $1,000 and your gross income is $5,000, your DTI is 20%. That's excellent. But if your debts are $2,500 and your income is still $5,000, your DTI jumps up to 50%, which is considered risky by most lenders. Most banks want to see a DTI below 40%. For mortgages, the cutoff is often 43%. Anything above that makes you a liability. This is the scenario that I see most often with people with great credit, but they don't know why they can't get approved for any more loans. You need to pay down your DTI. If you do that and at least get it below 40%, you should get approved for something you were once denied for. So before applying, pay down debts to bring your DTI as low as possible. Even an extra payment or two on credit cards can shift your ratio in your favor. Step number 3, don't make these common mistakes. Here's where a lot of people mess up. They'll spend months working on their credit and finally feel ready and then sabotage themselves right before applying. These are the 4 big mistakes to avoid. Number 1, don't apply for new credit cards or other accounts right before a loan application. Every new account that you add will change your average account age, and your debt load will also increase, raising your DTI. You also want to avoid closing old credit cards. It might seem like a good idea, but closing them will reduce your total available credit and spike your utilization percentage. I also don't recommend switching jobs right before applying. Lenders want to see at least 2 years of stable employment in the same field. Switching industries or starting a new business or taking a pay cut all will raise red flags. And finally, don't make a large purchase on your credit card right before an application. Now, this will depend on when your cycle date closes and your credit card reports. If it does show higher utilization, this will normally negatively impact your score in the short term and will also reduce your chances of getting approved for a loan. Depending on when your cycle date closes, your credit report may show higher utilization than normal, which would negatively impact your score in the short term and could be the reason you get denied for a loan. I have another video that talks about when to pay your credit card bills, so that way you can keep your credit score high at all times. I highly recommend you watch that video. I'm going to link that one as well. Step number 4 is income and employment verification. Lenders don't just want to see that you make money, they want to see that your income is stable and consistent. So depending on the type of loan that you're requesting, lenders may want to see your last 2 pay stubs, but some may also want W-2s and tax returns or even full financial statements. Some loans will not ask you for anything at all, and that's usually the loans that people want, the ones that only require stated income. You always want to keep in mind that any lender reserves the right to ask you for financial documentation, even if it's traditionally only stated income. So I highly recommend always having that information prepared. Have your paycheck stubs ready, have your W-2s ready, have all this information lined up. So if you're planning to apply for a loan soon, make sure you have everything prepared. Avoid making big employment changes unless they improve your stability on paper. So here's the bottom line. The truth is, lenders are not your friend. They don't care about your story, your potential, or even how much you may or may not need in a loan. In fact, a lot of lending can be done automatically without any sort of human intervention whatsoever. Banks care about risk. If you want to beat the system, you have to think like an underwriter. Before you apply for any loan, run your own financial profile through the same test they'll usually use. So to recap, check your credit. If you have debt, think about this like an underwriter. If you owe other people money, will you pay this person back? Chances are you won't. So if you have anything that you have not paid back, a collection, a charge off, why would I lend you money? Lower your debt to income ratio. If I already see that you're telling me you make X amount of dollars and you've already borrowed 80% of what you make, why would I think that you had the ability to pay me back? Again, think about this like an underwriter. Stabilize your job history. if you have spotty history with your job, I don't know if you'll be able to pay me back. So the longer you've been at a job, the more likely it is that you're going to be able to pay me because you have stable income. Avoid a large purchase right before an application. If you make a transaction for $8,000 on your $10,000 card, that is 80% utilization. And if that's one of your highest credit limits, that will negatively impact your credit score. And it's going to look like you're too reliant on credit, which will make you look risky to the bank. So you want to avoid that. Again, you can refer back to my video about how to pay your credit cards to keep your credit score high. I highly recommend that you watch that. And believe it or not, if you're able to hit all of these points, your odds of approval go to around 90%. Chances are you will be approved. And this is the credit hack or strategy, whatever you want to call it, that lenders will not tell you. Because if everyone knew exactly what to do, fewer people would get denied, and lenders make more money when they can justify charging higher interest rates to risky borrowers. So just keep in mind, it's not only about getting approved, it's getting approved on favorable terms. So now the information is in your hands, and you can use this information to increase your odds of loan approvals dramatically. I want to thank you guys so much for watching this video. If this information helped you in any way, please hit that subscribe button so you never miss a video, and share this with someone you know who's thinking about applying for a loan soon. It could save them thousands of dollars and the pain of a denial, because loan approvals aren't about luck, they're about strategy. And when you use the strategy I just showed you, you'll never apply for a loan the same way again. Once again, thank you so much for watching this video, and you guys have a wonderful day.